The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Hello and welcome to Your Money, Your Call. It's property night and I'm Margaret Lomas. Property may be a favourite investment for 1.75 million Australians, but it's also a prized target for the Australian Tax Office audit team. Property income and expenses feature strongly in annual tax returns, with almost $33 billion claimed as rental expenses each year and $5.5 billion refunded through negative gearing. According to the ATO Deputy Commissioner, there are up to 4,000 property audits and reviews each year by ATO staff checking returns against the three big property tax areas: income, GST and capital gains tax. And builders and home renovators in New South Wales can now go online to get their approvals fast-tracked. The new electronic housing code allows builders, homeowners and renovators to have their plans approved at the touch of a button. The first home to be approved using the new online system happened in just 3 days. The electronic housing code is now operational in 10 council areas: Bankstown, Blacktown, Lake Macquarie, Port Macquarie, Rockdale, Shell Harbour, Sutherland, Tamworth, the Hills and Tweed councils. The system will be rolled out to up to 24 more councils over the next 2 years. Now today's the cut-off date for getting your tax return in if you don't have a tax agent. And if you're staying up late to complete yours, then my guests tonight have some important information for you. I've asked Ben Kingsley from Empower Wealth and Ian Rodriguez from Bishop Collins Accounting to join me tonight to talk about those tax returns and of course any other question that you might have about property investing. So take the chance to get those last minute queries in. If you do have a question you might like to get in early by calling us now on 1300 30 34 35, or if you'd rather write it down you can and then email it to us at property@skynews.com.au. And welcome to the program. And welcome to you both. Now before we get to our news stories tonight and our questions that I've got ready to go for you guys, I want an interest rate prediction of each of you. Starting with you, Ian, what do you think is going to happen tomorrow?
Well, I don't like to gamble on much, so I'll say there will be an announcement. We'll go that much to certainty. I'm sort of tipping, look, a lot of the experts are saying there'll be a cut. I don't know, maybe they'll just wait and see a bit more. It's been wait and see for a long time.
Okay. Ben, you were quoting some interesting odds from the futures markets. What are they?
Look, after the the inflation data came out, there was 100% probability on the future markets of a rate cut. That's now around that sort of 75-80% mark. So, look, for me, it's about the planets aligning. So when I look at that, I think inflation, core inflation's down. I'm seeing the European zone sort of putting their cards in order. So I think with that alignment, I think the RBA have some room to move. And I wouldn't suspect it's going to be a trend. I just suspect there might be a realignment to a lower level. Nice Christmas present.
Now, of course, it could be a good Christmas present or it could just be a bit of a storm in a teacup, Ian, if the banks don't pass on the rate.
Well, that's the big one that most people have come to expect that the RBA, when they make these announcements, will automatically...
Taxman, RBA,
that's right, one takes it. But, that they will automatically be passed on. I think it was around this time last year when we were all probably a little stunned when it didn't happen, and they've gone beyond RBA movements. And interesting to hear from some of the banks. I was at a briefing with one of the big four banks, and there really isn't a fait accompli that they will pass it on. Time will tell. And Ben, you're suspecting that they may not?
Oh no, I'm probably suspecting that they will. But what I'm sort of saying around that is that the Treasurer's come out and said they better, or there'll be hell to pay. So I'm expecting them to pass it on unless something happens untoward over the course of the next couple of months in regards to the Eurozone.
And of course, Ben, the reason that the banks always give behind not being able to pass on a rate cut is that the cost of funds are going up, that their profit margins are getting shorter and shorter at the moment. In fact, that's true. Years ago, the margins were somewhere around 3%. Now they're down under the 1%. Do you think that's fair enough, though, for them to say that they can't pass it on for that reason?
Look, I think there's no doubt that the cost of funds is an important, the margin between the cost of funds and what they sell that money for is their profit margin. So I think there's got to be a balancing act that has to be played out, and I think the answer's somewhere in the middle. I suspect, that sort of 1.2 to 1.4 range is probably where the sweet spot is for all parties concerned, and I see that around that area at the moment.
Okay. All right, Ian, now it's the last day to lodge your tax return in the event that you don't have a tax agent.
Yes.
So I guess the trick there is that if you don't get it in by midnight tonight, then go out and get a tax agent.
That's right. Well, in theory, you should have one before midnight tonight. So.
But I guess, I suppose, though, if you go and get one tomorrow, if you miss the deadline to put your tax return in, then it'd probably be cheaper to go and get a tax agent than it would be to pay the fine.
Absolutely. Yeah, the fines certainly don't mess about. So,
have you seen anyone fined before for being late?
Absolutely, yeah.
And
people get
what kind of
fined.
money are we talking?
Well, each return can be $550 for some returns, and then, of course, subsequent year returns. So there's two levels of fine. One's a late lodgement penalty, and then there's one that's very serious, which is if you fail to lodge despite being told to, they can actually fine you and take you to court and issue thousands of dollars of fines.
Wow.
That doesn't happen too often, because most people generally, do the right thing. But you can avoid that sort of late lodgement penalty just by talking to the tax office. I mean, they're quite reasonable people. If there's a reason why you're late, and usually people have some, as long as you stick to what you tell them and go about doing it, they can waive that fine. They've got the discretion to do that. So certainly communicating with the tax officers.
Okay, well, look, take us through it. What are the items that people typically miss out on their tax returns?
Well, I'd have to say the number one thing that we see that people consistently miss is depreciation and construction allowances. It is one of the most generous sort of returns because you don't have to spend any money to make the claim. I mean, all you need to do is get a quantity surveyor's report. So,
because there's a little bit of money to be spent there,
to
but
get the
it's
report.
not huge, to get the report.
Of course.
Yep.
And of course that's tax deductible.
Yes.
So once you have that report, you've got many years of depreciation and construction allowance that can be claimed. And I still see returns when we get people coming in and you're looking at the property and when was it built? It goes back quite a long way now, and they're not claiming it. Some people say, is it worth it? And you quickly do the maths, a $400 or $500 report saving them $3,000 or $4,000 in the first year.
Well, look, let's make it really simple for viewers who really just aren't familiar with depreciation and what that all means. And I'm going to make it really simple, so don't pick me up on any of the technological stuff or the technical jargon here. Just say we've got a property that when it was built cost $200,000 to build, okay? So for 40 years, you can essentially claim from that $200,000, $5,000 a year as a tax deduction.
Pretty much.
Okay, now what that means, just for those of you who are trying this at home, is that the $5,000 tax deduction basically comes off the top of your taxable income, whether it's from property or from wherever it's from, and that's how much you don't pay tax on now. So if you've already paid tax on that, say you earn $50,000, then instead of paying tax on 50, you only pay it on 45. Technically speaking, then, if you have already paid it on 50, you get $1,500 back.
Correct.
So that's $500 to have your depreciation report done. You get $1,500 back in the hand. You're already $1,000 ahead.
Absolutely.
Okay, so that's the building. Now let's look at everything that's inside. All of those things inside. So all the different items, taps and carpets and blinds and light fittings and your stoves and ovens and all those things. You add all those up, and they've all got different periods of time over which you can claim them. But it wouldn't be unheard of for someone to have maybe another $3,000 to $5,000 worth of stuff there.
Well, sometimes, in fact, with those items, it's because the depreciation is sort of front-ended. Unlike the construction,
and goes smaller.
The construction allowance is over 40 years, but the depreciation is front-ended and is probably written to zero in the first 5 years, or close to that. So if you're missing it in the first 5 years, you've missed the most generous part of the claim. And you can't. once those years are gone by, you can't really go back.
Can't get them back.
But you can amend. So if you have got a property and you're hearing about this and going, oh my goodness, I should do that, you can amend. You can go back, generally 4 years for most taxpayers, and lodge amendments to those returns. So that's allowed to be done.
And so I guess it's probably not wrong to say that the average person out there who doesn't claim depreciation is probably missing about $3,000 to $5,000 that they could be getting in their hand.
Could easily be that number.
Easily that amount.
Easily.
So go out there and start claiming that depreciation.
Yeah.
Ben, just before we go to our email, because we've got a few emails that are coming in now, how should property investors get ready for that visit to the accountant? I mean, do you take your shoebox with you?
Well, I'll give you my example. I've got several properties and I just use envelopes. Now, I have my properties managed by professional managers. I do not do it myself. You know, they are experts, they're specialists at what they do. So most of the maintenance or claims that are occurring as part of that property are going to be delivered to me on a nice end-of-year statement. When I feel that there might be an expense, a travel expense or an inspection expense or something along those lines, I'll just put that in the envelope. And even if I'm not quite sure, when I sit down with the accountant, I'm just going to say, how about this one? And they're going to give me an immediate answer in terms of whether it's right or wrong. So, you know, let's list them. You know, any maintenance, the statements on the rental income that you're receiving, and any of those uncertain elements. And of course, depreciation schedules a must. And going back to that point, is it true, Ian, that you can go back 2 years in terms of if you've missed those depreciations over the last 2 years, you potentially can go back and claim them in this financial year.
Absolutely, you can go back, and it's up to 4 years for most people.
Okay, great.
The rules have changed around how far back you can amend, and it's different for different taxpayers. So, but for most individuals, it can still be up to 4 years.
Well, Ben, you know, I'm a bit worried about you and your envelope, so I will tell you that if you go to destinylive.com.au, there's an awesome new program that's being released, which will track not only all of those things for you, but spit out one single report at the end of the year that you just hand over to your accountant. No more envelopes for Ben. Destinylive.com.au.
Things in the machine.
Well, you need to go that, because based on all of my experiences and all of my husband's experience, we put this new program together and it's awesome. So you have to go and have a little look at that.
Fantastic.
Dave from the Gold Coast, I'm sorry to keep you waiting there. Thanks for joining us.
Thanks, Margaret. Hello, panel. How are you?
Good evening.
They're all great.
I've got a question re self-managed super fund. Is it possible to... I've got a duplex block, BA ready to go. How would the tax department consider a person as a developer if it was possible to develop the block in my name and then sell one of the duplex to the self-managed super fund? Is that a possibility?
The tax office is not going to like that, are they, Ian?
No.
No.
Short answer, no. I guess, look, the thing about that transaction you're talking about is a self-managed super fund can pretty much buy any asset it likes in general terms. There are some things that are prohibited, but it can't deal with members or an associate of a member and buy assets from them except for listed shares and except for business real property, which is generally commercial property but has a definition. So buying a residential property from a member or an associate is prohibited. So it pretty much puts an end to that plan.
Yeah,
Sorry.
So it's not going to work. You're going to have to sell it off just to the general public somewhere else. And unfortunately, your self-managed super fund isn't going to be able to do that for you. Well, our readers come up with all sorts of great ideas about how to increase tax deductibility on loans. And this week, Daniel writes, I bought my second house in 2004 and foolishly paid $250,000 of $550,000 as a cash deposit. The remaining $300,000, which I had received from the latest sale of my first house, I put into an offset account. Now, if I was to purchase another property and move into it while renting out my current house, I understand that the mortgage on my new house would not be tax deductible. As I want to access the equity in my current house to reduce the non-deductible debt in the new house, I understand it depends on what reason it's withdrawn or redrawn for. My question is this: can I redraw the equity for shares and then after a certain time redirect it to my new house loan? Ben, if you followed all of that, have you got an answer for it?
Oh, look, for Daniel, he's got a few things mixed up. he has. He's got the structures all around the wrong way, and I'm no tax expert, but in terms of the purpose of the funds, or the dominant purpose test, is if the funds that are being redrawn are potentially used for investment purposes, and Ian will correct me if I'm wrong here, they will be deductible. The fact that he's trying to have his cake and eat it too by trying to increase the debt on his investment property and try and reclaim that, the tax office won't buy into that.
Would you add anything to that, Ian?
No, just if people understand the rules, I guess, is the key thing. And actually, you talk about the things people get wrong. Number one right up there is claiming interest that they shouldn't be claiming. So that use of funds is a real key. So redrawing to buy shares, that's okay, that'll be tax deductible. But redrawing for a private purpose or to buy the new house clearly won't. He's sort of got half of it right, because he's put the 300 grand into an offset account, so he's preserved the nature of that original loan. So he's got it half right, which is better than I have. So.
And Daniel, what does happen is people often get very, very confused about the differences between what secures a loan and what its purpose was used for. If it doesn't matter what secures your loan, it's the purpose that the money was used for. So in the future, ask yourself, what am I using this money for? If it is to purchase an income-producing asset, then the purpose is investment and I can make claims. If the purpose is to some way gain a personal benefit, paying down your own loan, going on a holiday, buying a car, then you cannot claim it, even if your investment property does secure it. All about the purpose for the loan. Well, if you watch every week, you'll know that we give one viewer the chance to receive a copy of one of my books. All you have to do is ask us a question, either via the telephone or in an email. Then the panel and I will choose one question and send a copy of one of my books. Now, this week, the chosen email will receive my new book, Investing in the Right Property Now. And if you would like to know how property investing has changed since the GFC, then this is the book for you. And so any question that you have tonight about property could qualify as our question of the week, but only if we use it on the show tonight. So don't waste any time getting it to us by phone or email, and then make sure that you watch at the end of the show to see if you're the lucky person. It's time now for us to take a short break, but stay with us. After the break, the panel and I will be taking more calls and, of course, answering more email. Welcome back. You're watching the property edition of Your Money, Your Call. And this evening I have two great experts helping me to answer your questions. Ben Kingsley from Empower Wealth and Ian Rodriguez from Bishop Collins Accounting. Now, if you have any property question, you can call us on 1300 30 34 35. Or, of course, you can also email the question to property@skynews.com.au. And Peter from Gisborne, you have a question about depreciation.
Yes, my question is what happens with claiming depreciation when you sell? We bought a property 3 years ago that was brand new, and we're looking at selling it probably next year, and just wondering what happens with the depreciation then when you sell.
Great question. Now, of course, Ian, a lot of people say you've got to pay it back, but it doesn't actually work out that you're paying everything back that you've got.
Yeah, that's not the way to look at it. I guess if you have an item and you're writing it off for depreciation, when you do sell the property, it needs to be sold at a particular value. I think most people would accept that's at the written down value where it's not specified as any other number in a contract. So there's no adjustment to depreciation or your tax claim. The interesting one that it leads on to, though, is about what happens with the construction allowance.
Yes.
Which is a different story again. So two very different claims, one for depreciation, one for the property allowance, which is at 2.5%.
Now, the construction allowance is what we were talking about earlier, where the original value of constructing that property, and then you get a certain amount every year. But even then, you're not paying back all of the benefits that you got. You just have to make an adjustment for it,
Correct.
don't you?
Yeah, so the law was changed quite some time ago. Construction allowance was a permanent claim. And what they've done is said that you need to add back any construction allowance claimed when calculating the capital gain. Now, of course, the two major things about that. One is the capital gains tax, if you make one, is only 50% if that is taxable. And the other side of that is, of course, you may have been making the claim for 20 years and claiming each year as you go, and any clawback doesn't happen till sometime down the track. So when you do the maths, absolutely you'd want to do these claims.
Yes, exactly, Peter. And I'll add to that that I've done some calculations whereby people who are worried about making that adjustment, so for example, if you've claimed $15,000 worth of depreciation, you have to adjust that back off your cost base. I've done some calculations to see what would happen if you made no claims and then just had your cost base as is at the end and paid your capital gains tax, and what would happen if you made all your allowable claims and then paid your capital gains tax. There is a little more capital gains tax to pay at the end, but it isn't substantially more, and it certainly isn't a lot more than what you would be claiming along the way. You're far better off to make the claims along the way, and you should always be doing that. Plus you've got the benefit of the money now too. When you make those claims, you've got the money, you can probably sit it in offset, you can pay off some of your debt, you can get ahead by having that money now as well. Worth much more to you today than it is tomorrow. James from Brisbane, you've got a question about negative gearing. James, are you with us? No? James, give us a call back because we're waiting by and we'd be happy to take your call when you do call back. Of course, we have Ian on the panel. He can answer all of your negative gearing questions. Ian, speaking about negative gearing, we often hear people talk about negative gearing and they're worried that one day the government is going to turn around and change the rules, just as the Keating government did, and remove negative gearing benefits. The first thing that I would like to ask you about that is how realistic is it, do you think, that to consider that the government would stop us from being able to claim negative gearing benefits?
Probably a pretty low chance, I'd say. It'd be a very low chance that something like that would be changed. I mean, at the moment, to put it in the context of what's happening in the Tax Act and around taxes, we've had the Henry Review hand down a report to government making almost some 300 recommendations. There was a response from the government in relation to Henry Review, and then there was, of course, a tax forum held recently in early October, where there was a bit of some people calling it a talk fest, but I think there was some good discussion there, and people were pretty positive about it. Out of that forum, all they've said now is that there's more to consider, more to look at. They've sent tax concessions and other exemptions off to a subcommittee or a group to look at. I think they're going to be busy for a very long time digesting all of this, and I really don't see a political will to change it. It's going to affect decisions that people have already made.
Now, the other thing we have to really explain to the viewers is that the removal of negative gearing benefits doesn't mean that all of a sudden you have property and there are no tax claims left available to you, does it?
No, not at all.
So if they remove negative gearing, it's essentially the capacity to claim loan interest.
Correct.
And that's it, isn't it?
Well, you carry forward, so the rules definitely are that they're not taking away any deductions, they're making you carry forward those deductions till you're making a profit.
Yes.
So it's that time value of money. Instead of being, if you made a $5,000 loss this year, well, you don't claim it against other income, but you can carry it forward to
claim it off your
future
gain
years.
at the end, to get it off your gain at the end.
Could well be the gain off the end. So that exists in our Tax Act in some other circumstances around non-commercial business activities, the old classic Pitt Street farmer, as they used to call it, conducting a farm that's never going to make a profit and trying to claim those losses. So if there's certain rules around that, foreign income, foreign losses, a similar type of regime exists. So the mechanics are there in the Tax Act to do something like that. I think would affect a lot more people. And if there's any element of retrospectivity in it, it's very unpopular in tax reform. So I doubt that will happen.
Now, Ben, I guess if they do remove negative gearing benefits, which is, of course, the capacity to claim every year the losses that are generated from paying loan interest, then the people with the bigger negative cash flow properties will be the ones who suffer the most, won't they?
There's no doubt. I mean, they're the people who use negative gearing to the advantage in the early stages before the property eventually becomes cash flow positive. So, they're reliant then solely on the capital growth. But I'm with Ian. I think it's very, very low risk in terms of the government changing it. We see the data there, 1.75 million households of all voters who are owning investment properties. If I'm in agreement, there won't be any retrospective. If they do try it on, I suspect it will be something like a model where maybe the first one or two properties you'll get 100%, and then as you move through and build a portfolio up, there might be a tiered system where they might say 75%. Now, I'm not giving the HO any ideas here.
Yeah, look Look out.
But that's some of the conversation that was behind the Henry review, and it's behind some of the people inside, you know, that sort of talk fest that just went on. That's the type of model they might be looking at.
And I guess for now it highlights the need for all investors to be sure that they get that balance right between buying a property that's going to grow but also has cash flows that help them to stay in the market, even without those negative gearing benefits. Properties that have pretty good rental yields for the price that you're paying for the property, very important.
Margaret, it's exactly right. Back to the depreciation question from Peter. You know, we talk about, yes, it's added back to the capital cost, but it's the cash flow that it generates. It allows the purchaser and the investor to continue on their strategy to deliver the ultimate financial well-being that they're looking for.
Well, Robin from Perth, you've just joined us and you have a question about the first home buyers grant.
Yes, thank you, Margaret. My query was what is available now to the first home buyers for purchasing a established home and the stamp duty concessions, because I know they've changed.
Okay, now Robin, I will tell you that stamp duty concessions are a state-based benefit for first home buyers, and it is going to be different in every state. So this panel may not be able to tell you what is available in Western Australia. But let's go to the panel so we can get an idea of what is available. Ben?
The grant's available to you, Robin, and that's the federal initiative. My understanding is it comes into place for existing and new purchases under the value of $600,000, and that's an ongoing assessment until the 30th of June of 2012, until obviously we see the federal budget come out. In terms of state-based, I'm not 100% familiar with the Western Australian model for first home buyers.
What about you, Ian? Do you have any clients over there?
No, I haven't been looking at what's happening in Western Australia with those, but it's one of those things. I mean, it's been an initiative to get first home buyers active in the market, and the feedback you get is that a lot of them have probably bought into things that they maybe aren't finding it too easy to afford now that rates are actually quite a bit higher than they were when it went to the emergency levels as they were referring to it. So, you know, I don't know if they're such a great idea. So if people are looking at them, I mean, take advantage of them by all means if they're there, but certainly make sure you can afford what you're planning to do.
Only see them as the icing on the cake rather than the reason why you buy. Robin, most states are starting to wind back their stamp duty benefits for first home buyers, which will leave most states, and in many states are actually allowing stamp duty reductions for people who choose to build a new home rather than buy an established one. And again, I'm not certain what's happening in WA at this point in time. I haven't looked into it. It's pretty easy to find out, which we can do so. And if you wanted to email me at margaret.lomas@destiny.com.au, I can certainly find out for you exactly what's happening in Western Australia at the moment. Most states are winding back some of those stamp duty reliefs, but the first homeowners grant, which is federal, $7,000 grant, remains at the moment for the foreseeable future, and there is no discussion about winding that back whatsoever. Well, getting the right advice about property when you're ready to invest is tricky, and this week Jack asks, I'm currently looking to buy my first investment property. I'm looking to meet with my financial planner and accountant this week. What should be the most important questions that I ask them? Just quickly, Ian, what do you think Jack should be asking these people?
I think it's great that Jack's going to see both his financial planner and his accountant to get, you know, different perspectives on what he's planning to do. I guess the key things, you know, is understanding the return on investment and the cash flow on the investment, and making sure it fits with his overall plan. If you've got those two things right and you understand the investment, then making the right decision there's pretty easy.
Okay. Now, Ben, you can probably issue Jack a couple of warnings about who to talk to.
I certainly can, Margaret. In terms of going to a financial planner for advice on property, a lot of financial planners don't actually, or aren't accredited to give advice on property, or direct property as they call it, because it's not a licensed investment product. So if you're going to see a financial planner, he's going to talk to you similar to what your accountant may talk to you about, which is being able to afford it, whether it's the right thing to do as part of your overall investment strategy. My advice to you is to actually speak to a qualified property investment advisor and a member of PIPA, which is the Property Investment Professionals of Australia. They're people who are experts, or people who have been trained up in specific property advice for clients. That's the type of person I'd be talking to if I'm looking to start my property investment journey.
Some good advice there for you, Jack. And if I can just add that while you are talking to professionals about buying property as an investment, just make sure that they fully disclose to you exactly how they're being paid, and where somebody's giving you financial and property investment advice at the same time that they're selling you a property, there's nothing wrong with that, but just make sure that the property that they're selling you does fit with your overall goals and that it's right for you and that you're aware of exactly how that person is being paid. There are some operators out there who aren't quite as scrupulous as we would like them to be, who are selling properties that are over market value simply because they take large commissions. It's not unusual for someone to get a $30,000 to $40,000 commission out of the sale of a property to a property investor, and again, that might seem okay, but if that property is overpriced or overvalued, then you're the one ultimately who's paying that. So make sure you ask all of the right questions. You can go to pipa.asn.au, pipa.asn.au, which is the Property Investment Professionals website, for more information about how to choose a good advisor. Well, thank you for all the calls and emails so far. There's still plenty of time left to get yours in, so don't waste any time getting to your phone, computer or iPhone. For now, it's time to take a short break, but we'll be back soon. And if you do have a question for anyone on the panel this evening, remember the question of the week will receive a copy of my new book, Investing in the Right Property Now. So call us on 1300 30 34 35 or email us at property@skynews.com.au. Welcome back to the property edition of Your Money, Your Call. If you've just tuned in, this is your chance to get an answer to any of your property investing questions. Tonight you'll be speaking with Ben Kingsley from Empower Wealth and Ian Rodriguez from Bishop Collins Accounting. And of course I'm here too, so I can answer any property investing question that you might have. So call us now on 1300 30 34 35, or you can email us at property@skynews.com.au. Lauren from Adelaide, you've got a question about GST.
Yeah, I just want to know, my husband and I are looking at doing developments. We understand what capital gains tax is and how that works, but we just wanted to get a better understanding of how GST works on developments and if you have to pay capital gains as well on the same development, or if it's one or the other.
Okay. Well, of course, goods and services tax is entirely different than capital gains tax, and unfortunately one doesn't cancel the other out.
Yes, that's right. Yeah, you definitely got obligations for both. So probably the easiest way to explain it, Lauren, is that where there's a new item of residential property, and I think that's what you're talking in the context of. So if there's a new residential property that you're bringing about, land, building, all those things, GST will apply. So whatever you sell it for, 1/11 of that price will be GST. Like any good thing in the Tax Act, it's never that simple, but there are occasions where it may not be 1/11, where there might be a margin scheme or some other things that may complicate that, but it's probably getting a bit rarer that that's the case. So whatever you sell for is 1/11, if you assume, will be GST. GST, you've paid all the items while you've been building this thing. Of course, you can claim back as you go. So you're only paying 1/11 really of your profit, if you like.
Of course, they have to register for GST at the beginning of this whole thing.
Yeah, must register for GST and must lodge BAS returns either on a monthly or quarterly basis, depending on how you register. Most developers register monthly because, of course, you're getting refunds as you go till you sell. It gets a little more complex if you actually don't sell at the end and decide to rent these things out. There can be a GST adjustment, and that's the one that developers get caught on very, very commonly. So the intention is to sell, the market changes, they decide to rent it out. There can be a GST adjustment where you have to pay back all the claims that you made.
Oh, wow. That's not good.
No.
Yeah, I wouldn't like
we were
that.
talking about penalties earlier, BAS returns that are wrong, and there can be penalties for all of that. Now, after all that, hopefully you've still made a profit, and again, you're talking about whether it's a capital gain or a profit. But assuming it is a capital gain for one moment, then of course capital gains tax will apply to that whole transaction. But if you're talking about a build and sell, it's unlikely to be a capital gain. So, Lauren, you need to be mindful of that as well.
And so if it's a profit, how's that treated differently than capital gains tax? It's taxed like income, isn't it?
Ordinary income and taxed at your marginal rate, whereas capital gains, if it's been held for more than 12 months and it's in your own name, there's a 50% discount on the gain. So
that's a lot better.
So Lauren, all I can say is if you're going to enter a transaction like that, you really do need to have a good discussion with your accountant about all those obligations.
Ben, it just goes to show, doesn't it? A lot of people think, oh, I'll buy a block of land and I'll develop it, but it's not really something that the average everyday person should just dive into, is it?
Go to a workshop, go to a weekend intensive development course, and we're all developers. I think the best way to look at it is you're going into business. Now, going into business, you need good tax advice. If you're going into business, there's GST applicable. If you're making profits and you set up a company, well, that's different to a capital gain. That's part of the profits made in the business. So that's why it's obviously best to get the advice. And I would say to anyone, the numbers tell the story. So if you are looking to do a small development and you aren't technically going into the business of developing property, but you may be looking at setting up a rental income stream, then again, different variables are applicable from the ATO's point of view. So please get advice.
And we get back to purpose too, don't we? What your intentions are, or original intent, are very, very important. Think about it, write it down so you can prove what your original intent was, put it in an envelope and put it away somewhere. Scott from Albury, you've got a question about capital works deductions.
Thanks, Margaret. Great for your show, and thanks to the panel for taking my call.
My
question relates to the capital works deduction. I'm just looking at a situation whereby, say, you claim the 2.5% over, say, the 40 years, and you get, a deduction, say, let's pick a figure of $100,000, and you obviously claim that against your tax every year, and if you're on a tax rate of 30%, so you get a deduction of $30,000. What actually happens when you go to sell that property is that $100,000 come off the cost base of the asset, and therefore you'd pay whatever your marginal rate is, less the 50% deduction.
Okay, I think yes. So I think it's actually the 30,000 that comes off, not the 100,000, because you've only claimed 30.
Yeah, the best way to explain it, I think, is to say you've claimed 100,000 over time. And those claims that you've made reduce your cost base. So when you calculate the gain will be $100,000 higher than had you not claimed them. But of course, remember, you're getting a 50% discount on the capital gain. So if the capital gain's 100,000 higher, it's only actually 50,000 higher. Then you apply your tax rate.
At 30%, so that brings it down to only 15,000 of the 50. So now we're talking more manageable numbers.
And of course, the other beautiful thing about capital gains tax, it is the easiest tax to avoid. You don't sell. So, when you sell the property, you could sell it in a year where you have no other income. And of course, your marginal tax rate in that year might be 0 or very low.
And there's no capital gains tax on unrealised gains, as you've just pointed out. I suppose, too, to have claimed $100,000 in capital works deductions probably means you've had the property for a very, very, very long time. I mean, with an average claim of maybe $5,000 a year, then if you're claiming $100,000 in total, you've had it for 20 years.
Yes, absolutely.
In that time, it may well have doubled and doubled again, in which case that then brings that $100,000 into a bit more significance too. It's actually a fairly small amount when you project it that far in the future. Most people would think, well, $100,000 in 3 years' time is a lot, but over 3 years or 5 years or even 10 years, it's a much smaller amount that we'd really be talking about.
The calculator does not lie.
No, it absolutely doesn't. Well, let's hope that that's helped you out just a little bit, Scott. Now, just before we go any further and go back to the phones, I'd just like to ask one last question of you, Ben, and it's in regard to those tax claims that property investors make. Property investors, as you say, have to keep all of their documentation and take it along to their accountants so that they can make their tax claims correctly. What happens if somebody is just totally disorganised and they, after 3 years, they've had a property and they've made no tax claims whatsoever and they've kept nothing? Is there anything that you think that they can do in that regard?
Well, first thing I would be doing is contacting my tax agent and saying, this is my circumstances. I would suspect, again, the ATO is made up of people. It's not a monster of any nature. When you're actually talking to the people, explain your situation. Would that be right, Ian, in terms of this is the circumstances? But look, if you haven't got any record of those deductions, I certainly know that, obviously it's a self-assessment system at the moment until they come knocking on your door.
That's right.
And then you've got to prove the expenditure that you've had over that time. So I would be saying to people that it's best to play an open book and to do whatever you possibly can to secure those receipts of any expenditure that you've had during that time, and obviously any income that you've received over that time as well. If you go back to your loan documents as an example, they're usually costs broken down. If you've used a mortgage broker, they should have a record of the application fees and everything else that's been set up associated with that loan, and hopefully you haven't been managing the property by yourself. You've used a professional to handle that property management, and hopefully they'll be able to go through some records and find some information.
Excellent. Well, I've got Ian on the panel tonight, and every week it seems that the 6-year rule pops up. Someone always writes in a question or rings up about it, and this week Sharman and Reg asked, we were offered to live rent-free back in May 2006 and rented out our home in November 2010. In November 2010, the tenants moved out and we decided to renovate and sell, but it's been on the market for a while. We're reluctant to move back in as we can continue to live rent-free for at least another 18 months. Because the 6-year rule lapses in May 2012, we've been advised by our accountant that if we move in for a minimum of 30 days, then we can re-rent our principal place of residence and the 6-year rule will apply. I'm yet to confirm this with the ATO, however, is it correct? Ian, 30 days, is that the prescribed period of time?
No.
Okay, so your accountant is not correct.
Well, I don't know that there's any particular period of time. I mean, the 6-year rule is quite a generous rule. So for starters, essentially what the taxman is saying is that once you've established a home as a principal residence, you can actually rent it out for 6 years and still have it exempt from capital gains tax. Pretty generous rule.
And you can make all those claims along the way too, your deductions still.
Yep, they're
so
fantastic.
Great.
So it's the best of both worlds. All the deductions, all the claims, and no capital gains tax. So, of course, they're limiting that to 6 years, so they can't let that go forever. The rule does go forever if the property's not being rented. So, therefore, there are no claims on the property. So, again, you could keep it for 10 years empty and still pay no capital gains tax. But, of course, one principal residence per family. So the limit is there. I think Reg was asking about restarting the 6 years. So if you move back in and re-establish the home as your principal residence, then of course you could move out again and go another 6 years. So Reg is sort of saying, well, I have 6 years, I'll go back in for 30 days and I could have 6 years and maybe do 30 days again. Important to note that the 6 years can be intermittent. You can have periods of time where it's available, not available for rent. But the 30-day piece is a piece that's not anywhere in legislation. The tax office has always had the view and maintained, and all their guidance says the things that they look at to decide whether it is, and it's a question of fact. So I think the accountant is probably giving him some guidance. There's probably been some cases and decisions made where certain numbers of days have been accepted, but it doesn't mean that for everyone it's that. You really need to establish where you live, where you vote, is the power on, all the things that determine if you're actually living there.
And again, it comes down to intent, doesn't it? Clearly, if your intent is to move in for 30 days just so that you can gain another 6-year tax benefit, essentially, then the tax office is going to go, no way, mate, that's not happened. You only moved in to reset.
That's avoidance.
Yeah,
that's the
tax
clearest
avoidance.
determination of avoidance, and that's illegal.
But if you moved in and set up your power and started to get your letters delivered and you were back on the electoral roll and the kids were enrolled in school and suddenly your employer said, mate, I need you to move to Queensland, and you were out in 30 days, under those circumstances, probably 15 days is probably even acceptable because you genuinely meant to live there and this other opportunity came.
The taxman actually says that, I agree with that entirely, but the taxman actually says that there is no minimum time. So
no minimum time, but the intent must be that it really is becoming your principal place of residence, not that you're just trying to reset another 6-year period. So Sharman and Reg, please be very careful with that. The tax office will investigate people randomly from time to time. You don't want to be caught out looking like you were just trying to avoid tax. Well, thanks for all of your questions so far. It's time again for one last short break, but we'll be back. And if you'd like to call up and ask us any question about property, call now on 1300 30 34 35, or you can email us at property@skynews.com.au. Welcome back to the Monday night property edition of Your Money, Your Call. I'm Margaret Lomas, and with me on the panel tonight is Ben Kingsley from Empower Wealth and Ian Rodriguez from Bishop Collins Accounting. Now, there's still a short amount of time left for you to call and ask us any question about property investing. The number is 1300 30 34 35, or you can email us on property@skynews.com.au. And don't forget, we'll be choosing the question of the week from all of our callers and our email. That person will be in the draw to win a book. This week it's Investing in the Right Property Now. So you've just got some time to get those last minute questions in and ask the panel for their expert opinion, and possibly even take home one of my new books as well. Ben, you were just saying in the break that a lot of people don't understand about the 6-year rule. They think that they have to sell their property at the end of it, but that's not the case.
Look, my understanding is that's not the case. Take, for example, my wife and I have got a property in Alexandria in Sydney. I used to live in Sydney years ago. We moved back to Melbourne and we rented that property out. Now, that was our principal place of residence. We had intention to potentially move back to that property. After the 6-year period came up, we got the property valued and we spoke to our tax advisor, and he said that can potentially lock in the capital gain. So if the property's doubled in value over that period of time, you don't have to sell the property inside that 6 years. I think a lot of investors think that they've got to go out and quickly buy that property, and that's not the advice that I've received.
Okay. Now, Ian, of course, if it starts out as your investment property and then it later becomes your principal place of residence and then it becomes your investment property again, then in that case it's got to be about the beginning price, the end price, and then days rented and days not rented, and proportionate capital gains tax, doesn't it? You can't have valuations. People think that they can get valuations done in that period of time in the middle, and if that tends to be the part where it's grown the greatest, they can just slice that out. But it doesn't work like that.
That's the key, is understanding the rules, Margaret, and that's it. If people understand it, you can understand in which situations you can get a valuation, in which situations the gain's going to be on number of days. And the point Ben made about the 6-year rule, I mean, people have got to understand that you don't need to sell it at the end of the 6 years. You can keep it longer than that. What if you don't rent it? It's an indefinite period of time. And the other thing about the 6-year rule that's really neat is the fact that you don't need to make the decision about which property you're going to claim as exempt until you actually sell one of them. So if you have two and you've lived in both, they're being rented, you're living in them, you can decide which one has the gain or which one has the least gain and make the decision about which one you're going to claim that 6-year rule on, and you don't need to do that until you actually sell one.
The other thing too about that principal place of residence exemption is that I know I had a caller through, or an email through the week at the office, saying that they had 2 properties. He moves between them up one and down to the other and moves between them all year. Can he claim them both? But you can't. You can only have one principal place of residence.
You can have 100, but you can only claim one.
Only
That's the best way to put it.
Okay.
I think the point that Ian's trying to make there is that it's in the numbers, isn't it? I mean, you don't have to write to the tax office and say, this is my principal place of residence. So once the determination's been done, if one of them's sold, you potentially can go to your tax advisor and work out the best way.
Absolutely.
Yep.
John from Sydney, you've got a question about Helen Vale.
Yes, hi, good evening. Thank you for taking my call. Look, I've got about like $400,000 that I want. It's going to be like my first investment property. Now, the thing is, I know like in Helen's Vale, it's already like sort of boomed and it had like a large growth, but lately the price has dropped heaps. And I was thinking, I guess, in a stock market sort of theory, like, you know, like buy on the low, and I was thinking whether it would be a good area for growth. Now, like I sort of seen as well, like on your show a few weeks back, you were talking about Port Adelaide as a really good place to invest. But unfortunately, the prices that I've seen on the net are generally like above what I can afford. There seem to be around the 500,000. And as well, I guess as well, any advice you can give me on like maybe buying interstate, because I'm from Sydney, and I'm not sure if I should like maybe put a like a buying agent on my behalf, because then it's hard to go up see a property every time you see one.
Okay.
I'd really appreciate it.
A lot of issues here for you. And now, can you just tell me, Helensvale, is there a reason other than the fact that you think it's dropped in value that's taking you there? Often people have friends who are bored in an area.
Yeah, that's right. Yeah, like I got some friends there, and I guess because I've been in the area, and just makes it that little bit, I guess, easier to because I've seen it. You know?
It doesn't, John. Makes it harder when you've seen it, because all that happens is you buy into that whole emotional argument about it. You've seen something, you think you like it. Trust me, we do not have an instinct for what's right in property investing, and only the facts and figures can tell us where to invest. Ben?
It's the fundamentals, John, and I suppose I'll put the question to you. What's the commentary about why the values have gone down? What can I ask you that question?
Look, I guess my understanding, I could be wrong. Maybe too many people rushed in the first place. Maybe like there's a lot of people that instead have bought it as a second home.
So it's had a run basically.
They're selling now. I'm not sure.
Yeah, look, the fundamentals will tell that story. So that's the research you need to do if you are looking at Helensvale. I mean, just because something's gone down and you think it's coming to good value, it's got to have the fundamentals there. It's got to have the employment. It's got to have prospects for income growth. It's got to have population growth. It's got to have sustainable economy. All the fundamentals that Margaret oftenly talks about in terms of that. So my advice is keep searching and keep researching.
Okay, and John, if I can just add to that, I know you feel safe and comfortable with Helensvale. The theory with the stock market doesn't apply to property, so it isn't necessarily buy in a low and then hope that it's going to go up just because it went low. It doesn't work like that. All of the fundamentals of good investing are all of those growth drivers that we so often talk about on this show, and they'll occur all over Australia. You do not need to go and see a property in order to find out whether it has investment fundamentals, and nor does a buyer's advocate for you. You just need to know what those investment fundamentals are so that you can pick an area that satisfies it. That's why we talked about Port Adelaide the other week. There are lots of parts of Port Adelaide, and you're looking in the port itself, but I'm talking about the entire shire of Port Adelaide. Is a lot cheaper than 500,000, and there's even better areas that will probably grow even better down around the Onkaparinga Shire. Lots of work for you to do yet, John. Please don't jump into that Helensvale property. It's not at the top of my hotspot list. Tim from Tamworth, very quickly, you're our last caller. Now you've got a question about Tamworth.
Yes, it's just a layman question. My wife and I are looking at buying our first property together. My wife's owned a house before.
Yes.
So I miss out on the first homeowners grant.
Okay.
We're hearing a lot of stories from friends that either the market is going to become a buyer's market within the next 6 months when we're looking at buying.
Yes.
Then other people are saying it's going to pick back up and it's going to be a strong seller's market.
Okay.
I was just wondering if you got any idea what it would be like in Tamworth.
In Tamworth, is this a house for you to occupy?
Yes.
Okay. Ian, New South Wales, Tamworth, what's your feeling?
Well, I've been out there quite a bit. It's a great place, Tamworth. I love going out there. In terms of investment, the same rules apply. I don't think, the markets don't move that suddenly and quickly in property. So I've been looking for the bargains and waiting for the bargains to appear for the last few years since the GFC was invented, and we're still sort of waiting. I mean, it's a pretty good time to buy now. People worry about interest rates, they worry about the market. You can lock in your rates now at pretty much today's rate for a long, long time. So I don't get too excited. Find something you like, make sure it's fundamentally right, and live somewhere you enjoy.
And Tim, look, just so you know, I was up at Tamworth just about 3 months ago talking to your mayor. I've got no problem with it being a great place to buy, and I think now is the time for you to buy. I wouldn't be waiting around. The market's heating up a little bit up in Tamworth, and it's certainly going to be a good place for you to settle, lovely place to live, and you should get a really good buy at the moment. Well, that brings us to the end of another show. Of course, I'll be back again next week, and joining me will be Lisa Montgomery from Resi and a great new guest, Rob Belander from MBA Lawyers. Now, be sure to get those questions ready. You can email them to me during the week, and I'll do my best to get them answered, and hopefully won't have foot in mouth when I'm doing so. Our question of the week this week came from John from Sydney, our second last caller. John, you wanted to buy in Helensvale. Panel think you should look around a little bit. My new book, investing in the right property now is exactly what you need. It's certainly going to help you to be able to buy sight unseen and help you to understand what those investment fundamentals are. Just send me an email to yourmoneyyourcall@destiny.com.au and we'll send the book out to you. Thanks to our guests, Ben Kingsley from Empower Wealth and Ian Rodriguez from Bishop Collins Accounting. Always a pleasure to have them on board, and of course they'll be back again soon. And in the summer series of Property Success, this weekend the REI NSW joins me with some great buying and selling guidelines. You can catch that show on Sundays at 1, 5 and 9 p.m. I'm Margaret Lomas. Thanks for your company and have a great week.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.